So the quote here is, how does the risk index work and what does it mean in real life?
Yeah, in real life. So risk is something that we choose to highlight because returns and risk come hand in hand. When you have an expectation of a high return, you're really taking on more risk. And the inverse is true. If you're not taking a lot of risk, your expected return should be lower. So the way we use this risk index is this metric called value at risk. We use a 99% chance of making a loss or not. So if you have a risk portfolio that's 20%, you have 99% chance of losing less than 20%.
Okay.
And you have a 1% chance of losing more than 20%. It's a risk term that a lot of sophisticated investors use to really measure risk. Yeah. So how does it work in real life? How you could think about it is, if we go through a financial crisis, there's a chance that you could lose more than that risk index. If that risk index is 20%, you have a 1% chance of losing more than 20%. So 1% is a very low chance, and we like to highlight that up front because the more risk you take, the more expected return you should be able to get. And the less risk you take, you should also be looking at less returns. We don't just talk about returns. It's also about the risk.
Yeah.
Yeah.
Okay. And I guess this is somewhat connected. But can you explain your ERAA model to non-finance professionals? What is that?
Yeah. So ERAA or ERA is the main thing that differentiates us from a lot of other robo-advisors. A lot of other robo-advisors simply put your money in a portfolio of ETFs, and that is purely a passive vehicle. But for us, we want to improve on this model by having our own proprietary investment vehicle, our own proprietary investment framework. So ERA, for the layman out there, tries to put your money in the right investments at the right time. So by time, I mean where we are in the economic cycle. There are a lot of things that affect the prices of different asset classes, but we believe the main driver of that is the fundamentals of the economy, how healthy an economy is doing or how badly an economy is doing. So if we are in good times, we will give you more growth assets, things like tech or consumer discretionary or emerging markets or energy. But if we swing to a downturn and move into a recession, then we'll give you more protective assets so you don't lose so much of the value of your portfolio. So we invested in things like bonds and gold, consumer staples, and ultimately it's about trying to ride out the different cycles. You don't want your portfolio to be so volatile like a yo-yo. You want it to be exposed to the upside in good times and be protected in bad times.
Yeah. So how does ERA decide which economic regime we are in and adjust to that?
Yeah. So we look at we look at economic fundamentals. And for us to do that, we extract information from governments and statistics all around the world. So we look at indicators like industrial production and inflation, and also some leading indicators like the Conference Board Leading Economic Indicator Index, or CBLEI. It's public, you can look it up. It's done by an independent think tank in the US to kind of look forward into the future using 20 or so economic indicators to predict where we are in the economy.
Okay.
So we look at data from official sources relating to economic fundamentals.
Okay. And how reliable would this algorithm be when faced with an unprecedented crisis with no historical economic data?
Yeah, then it's really, you're talking about a black swan event, right? A very, very isolated event where something happens and past performance doesn't indicate future performance. For that situation, I'm not going to lie, we don't know what's going to happen.
Yeah.
But I think the protections that you put in place are a portfolio that is diversified. If in that situation certain asset classes are badly hit, then at least you have some that will protect you from the downturn. So for example, in the financial crisis, there were a lot of uncertainties then. So asset classes like commercial real estate or retail real estate did terribly, lost a lot of money. But things like gold actually went up in value in those 2 years during the financial crisis. So we have different components within the portfolio itself which should protect you from unprecedented events.
Yeah.
Yeah.
Yeah, and I think I get asked this every so often as well, of like, oh, what if the stock index dropped to zero? And then for me, like my answer is, at that point, like the last thing you probably are worried about is getting your money back, because there's probably world chaos at that point, right? And that money is probably not going to be your biggest priority.
Yeah, there are risks associated with everything you do.
Yeah.
So that's why we always advocate to have 3 to 6 months in cash in your bank. At least if the stock market tanks, you still have access to your cash. And then you should have also 3 to 6 months in liquid assets. So if you see the stock market tanking and you want to pull out your money, you can pull it out quickly.
Yeah. Okay, so we still have another question, but with ERAA.
Yep.
So how did ERAA respond in the days leading up to the moderate recovery in Q4 of 2018, sorry. So, remember in 2018, like Q4, like all of a sudden the economy, or the US market anyways, went down like 10-20%. And then how is it predicting, I guess, the coronavirus uncertainty right now?
So that's why it's really important to have an investment framework. And that investment framework will have a point of reference that is based on something like economic fundamentals. If you have a normal fund manager going through those ups and downs, it's very emotionally charged, there's a lot of anxiety, so they might not be at the top of their game and their judgment might be clouded. That's why it's important to have an investment framework. So in Q4 2018, where we had a correction, the market went down almost 20%, it was 19 point something percent. We were faced with a decision. The model said that everything is fine, the US market is not in a recession, the global markets the global economy is still not in a recession. Should we respond? And Trump was tweeting almost every day, and that's what drove markets down. So we looked at ERAA, and ERAA didn't suggest any changes to the asset allocation. So we stuck to our guns in Q4 2018. And I think a lot of fund managers would take the safe route and actually put a lot of that money in cash.
Yeah.
And would actually put it in safe asset classes. But then they would have missed out on January and Q1 in 2019, where it was the best January in 15 years. And it was the best first quarter in, I think, since 2011. So you just don't know where you are, and you need to be in position to be able to benefit from the upswings. So in that situation, it was really good that we had an investment framework, and we responded very well. When we look at the coronavirus, obviously these are things that could and would impact economies, because you're talking about factories shutting down, travel bans, health risks, and things like that. It will affect the economy. But at this stage, the US economy is still sound and the market is still climbing. It's not affecting US economy yet. It would affect the Chinese economy in a few quarters down the line. And if we see a slowdown in the global economy as a whole, we would shift your assets to something more safe, like bonds and gold and things like that. The issue with trying to predict what would happen is if we switch your portfolio too early and we find a cure for coronavirus in 2 months, there'll be an upswing in the financial markets and we would miss out on that. That's why we don't predict using external factors like the virus. We look at economic fundamentals. When the global economy has shown the effects of the coronavirus, then we'll respond.
Perfect. Thanks so much, Ken, for participating and helping us understand the basics of investing, what people should be doing, and how StashAway can play a role in their investment journey. And for the people who are watching right now, thank you so much. If you have any other questions, feel free to leave a comment down below, and we will try to answer that for you as soon as possible. Otherwise, check out the other videos that we have with Ken here. We have a bunch of other questions that we have recorded and hopefully will help you in some way, shape, or form. And if you're ready to take the next step in joining StashAway, just feel free to use one of the links below in the descriptions, because you'll get some bonuses that you can't find anywhere else. All right, thanks a lot.